Hello, fellow value investors. Earnings season's in full swing, and here are the five stocks that I'm going to be buying before their earnings. Two of these have earnings this week, two of them have earnings the next week, and one of them has earnings the week after. All of these are positions I hold. All of these are below my cost basis, so I'm buying all of these, and I think they're a better price than when I started buying them. So I don't want to waste your time. Let's get right into it. The five stocks are Microsoft, Meta, Uber, Celsius, and New Holdings, in order of, I would say, popularity. We're going to go into each one of those, but first I just want to explain my general thought process of how I analyze stocks, how I view pricing a stock. So let's just say here's a stock chart. This lasts 5 years for Microsoft, actually. We're just, it could be any stock. We're just using it as a visual. So the way I see it, every stock has some true value that we can never know. The stock price roughly tracks its true value, but that is an unknowable value. You can make a guess at that value, and depending on your ability, your guess is going to be somewhere within a range, right? Let's say now this is our guess of the true value, and the real true value lies somewhere in this blue area. You would fundamentally like to buy it when it dips below that and sell it when it goes above it. And we're going to say the true value is the price you would buy that would give market matching returns, right? Now, if it's a really high quality stock, I'll shift that whole thing up. So if I love the company, then I'll buy if it's just a little below where I think the true value is, and I'll sell if it's much, much higher. And if it's a really low quality stock, I'll shift the whole thing down and I'll be buying if it's way below what I think its true value is. And I might sell if it just recovers to what I think true value is. So the first stock we're going to look at in our analysis software is Microsoft. Absolutely giant name, and it's being beaten down for a few reasons. In my opinion, Microsoft, it falls in the middle ground as far as quality of companies. They have an indomitable moat, I would say, but I don't love management. And especially, I've dealt with Windows, I've dealt with Xbox. I know their management makes some missteps, but their moat is amazing. They have high switching costs, they have a huge network effect. They have this bundling method of keeping people locked into their ecosystem. They're already paying for the bundle. Switching off the bundle will be a giant pain in the ass. And they come out with a new product, and the new product doesn't even have to be good. They just add it to the bundle. They raise the price of the bundle a little, and to the people, it's like it's almost free. I know people who work high up at a lot of companies, and that tell me that they're going to be using Copilot just because they're already paying for Microsoft. They already have contracts with Microsoft. They have privacy deals with Microsoft. Microsoft already has their data. They already have all their eggs in one basket, and they're not going to go try out Claude or Gemini. So it doesn't even have to be better than those. It just has to be good enough that their customers aren't willing to switch away, right? So it's pretty undervalued. If we just look at the analyst consensus target here, we see a 32% upside. And if we look at DCF, and if DCF on a tech company shows that it's undervalued, that's usually good because they're almost always going to do better than a cash flow analysis would say. And the DCF saying 42% undervalued. That's crazy right there. So what I like to look at here, if we look at the growth numbers, we're seeing future growth about 14%, 14.6, 13.7. If we look at past growth, 13.5, 12. If we call it 13% growth or so, we can add in the dividend and the buyback. So that gets us to like 15% growth, right? On the financial health side, beautiful financial health, debt to equity ratio of 9.7, negative interest coverage ratio. That means they're earning more in interest than they're paying, right? That's as far as them, say, financing deals or whatever. They let people buy a phone or a laptop and pay it off over time. They're getting more money in interest than they're paying out in interest. So really the debt to equity ratio is nothing. So they're in a beautiful position of financial health. They're paying that dividend. And if we look at the valuation, they're basically growing 15%. If we add the dividend and the buyback and the growth together, 15, 16%. And they're at a PE ratio of 22. Now, I mean, if we just look at what's the PE ratio of the S&P 500 right now? 28 to 29, right? What about the NASDAQ? PE ratio of the NASDAQ. Can we get this number quickly? It's 26, 24, 30, 31. So Microsoft's trading below the index. They're getting beat down in the SaaS apocalypse. If we look at the forward PE, it's 20. So they're trading much cheaper than the index right now. So if we take this 22.6 PE ratio and we divide it by that growth rate, and I view dividends and buyback as part of the investor returns. What the company itself is going to grow, what it's going to buy back, and then what it's going to pay out to investors. So if we divide that by about the 15, maybe 16% growth rate, let's just call it 15. They're also doing big dividend growth of almost 10%, which I might add another 1%. So about 1.5 to 1.4 PEG ratio is, I think, very good. This company is offering a margin of safety of about 30 to 40%. So, as I said before, Microsoft's not my favorite company in the Mag 7. I wasn't buying Microsoft all the time, but I have been buying Microsoft anywhere 400 and under. My cost basis is like 395. It's at 381, and I'm going to keep buying it until it goes back above 400. 40 to 30% margin of safety is more than enough for a company like Microsoft, in my opinion. So now on to the next company. So on to stock number 2. Now, stock number 2 is Meta, the only other Mag 7 stock on my list. And Meta is probably the cheapest Mag 7. I had Claude run a little analysis ranking the Mag 7 by various valuation metrics. So by trailing PE, it's Google first and then Meta number 2. And the Google one is distorted by an investment gain, I believe, with SpaceX. Because I bought that at like $8 a share. Forward PE, Meta is the cheapest. Price to earnings to growth, Meta's number 2 after NVIDIA. NVIDIA, of course, has crazy growth, and NVIDIA is another position I have. Price to free cash flow, Meta's the cheapest. Price to sales and price to book, it's number 2 after Amazon, and that's because Amazon is lower margin and more asset heavy than the others. So at the end of the day, number 2, number 1, number 2, number 1, number 2, number 2. Now, the reason for this, I think, is it's probably the second worst company in the Mag 7. It has this wonderful cash engine that is its advertising business. I think if you want to compare Meta, you can compare it to something like Amazon that has this cash engine of its cloud business, right? And they both try and use this cash engine to take over other industries. You know, Amazon uses that to spread and take over distribution. They can take over audiobooks. They're trying to take over the grocery business. Whatever business Amazon wants to get into, it has this money machine throwing out money and it throws it at the business. The difference is Amazon, Google, these other companies, they do a really good job with all their side projects, like maybe 50-50 success rate. Meta does a really bad job. They've yet to really be able to diversify. The Ray-Ban glasses are maybe going to do it, but they are creepy. Maybe their AI is going to do it. Maybe their data center is going to do it. But the good thing is that core cash engine is it's still there. It's still wonderful. So once again, if we look at future free cash flow, and any of these are undervalued by free cash flow, that's a really good sign. It's 27% undervalued. And where's the analyst consensus target? 28% undervalued, according to the, I meant to set fair value. But if we look at Meta here, growth, we're looking at 14 to 16% in the future, in the future. In the past, we're looking at 17.7 or 14. So if we want to look at all these together, we can call it 14% growth. If we look at the dividend, there's a 2% buyback that's probably just offsetting stock-based compensation, if I had to guess. Stock-based compensation, $22 billion. Let's pull out the calculator. Sorry, give me a second. 1,500,00 times 0.02. So 30 billion in buyback, and they're doing, what is it? 22 billion stock-based compensation. So it's a little more. So we're not going to count it. We'll count about 0.6 of that. So altogether, between the dividend and the buyback, it's about an extra 1% growth. So once again, 15% growth, similar to Microsoft in that area. I guess we can look at the financial health, 24% debt to equity, also negative interest coverage ratio. So once again, they're earning more interest than they're paying out. Their equity's growing like crazy. So I'm not worried about that. There is no insider buying. There was a little on Microsoft, but if we come and look at these valuation metrics, it's 21 PE. Once again, we looked. The index is trading in this like 26, 28, 30 PE area. So cheaper than the index. Great growth, great cash flow. The forward PE is 17. So for that's I would buy a very boring company 17. Meta, it's very low. If Meta reached fair value, I will sell my Meta. If it doesn't even need to get to fair value, I'll sell. I don't like the company, but it is so cheap. It is the cheapest Mag 7, and I don't think it deserves to be as cheap as it is. 17 forward PE is the kind of thing I'd pay for a company growing maybe 9%, right? Or 10%, but they're growing 15%. So if we want to once again plug that number in there, 21.4 divided by 15, 1.4 PEG again. I think this is great for these asset-like businesses. I think they have a lot of things that could go right. I agree with their logic that even if AI doesn't work and these data centers don't work, and I agree with this for a lot of them, they'll just be able to rent that data center time out. They'll be able to do a cloud business, whatever. They're always buyers. They'll be able to get some return on that investment no matter what. And even if they don't, they're just throwing off so much cash, and this line just goes straight up. And that's something I probably should have included from Microsoft. If we look, it is just so reliably going up and compounding, right? Even if free cash flow dips here and there, these are two wonderful companies. The Mag 7 are wonderful companies, and these two are trading at dirt cheap valuations. So on to stock number 3. And that's Uber. So Uber is, if you look at it here, 68% undervalued according to future cash flow. If we look at an analyst consensus target, 37% undervalued. The numbers here are pretty universally agreed upon to be good, right? The issue is the future of the company is very, very uncertain. It's very uncertain if self-driving will be a headwind or a tailwind for the company, right? The bear case is that Tesla, let's say Tesla wants to kill Uber. Tesla wants to make every Tesla a robo-taxi overnight, snap their fingers. Everyone owns a Tesla, can have it doing taxiing while they're at work or while they're asleep or while they're working from home, whatever. And suddenly everyone gets off Uber and goes on the Tesla app and orders their cars through the Tesla app, right? My thesis is, yes, if that happens, that's bad for Uber. But every single extra company that has self-driving makes Uber's future brighter and brighter. So if it's just Tesla, then Tesla will kill Uber. Let's say it's Tesla and Waymo. Okay. Are people going to have a Tesla app and a Waymo app and check them both and see which one has the closer car at a better rate or whatever? Yes, I think that they still might do that. But then if we keep going, Amazon wants to get into self-driving cars, right? There's Chinese self-driving cars, BYD or Xiaomi or whatever. Maybe they'll have apps. Okay, well, if there's 5 apps, are people going to download 5 apps and check 5 apps to see where the cars are? I would say almost definitely not. So the more companies that have self-driving cars, the more and more likely it is that people still need an Uber, because Uber's fundamental business model is connecting riders to drivers, right? Or to cars, and they do it for logistics too now. And they're getting into travel stuff, booking your hotels and stuff because you use your Uber to get around when you're on vacation. They're doing all sorts of stuff. But fundamentally, if there's 20 self-driving car companies, if Ford has self-driving car, if there's Honda's with self-driving, whatever, then suddenly you still need Uber. Uber's going to show you all the self-driving cars around you. All these self-driving car companies, they don't want to be fighting over each of them has some little island of self-drivers. They might have their own app, and their own app might have higher margins, but they're going to have excess supply of self-driving cars that need to be connected to drivers, even at lower margins, and they'll use Uber. People will still use Uber and pull it out and order self-driving cars. Now, on top of that, not needing drivers will increase Uber's margins. The insurance rates are going to be cheaper if crashes are less likely, and car ownership might go down if people are moving on to self-driving cars that are more expensive, and it becomes cheaper to order a car. If you're not paying the driver, if the car drives itself to you, then it's going to be cheaper for you to order a car. It's going to be a lot more common for people to Uber around because the cost is going to go down. So I think all of these things lead to the idea, if there's a lot of self-driving car companies, it'll be good for Uber. Will there be a bunch of self-driving car companies? Yes. NVIDIA has put out open source self-driving models. There is no longer a need for a proprietary self-driving model. Ford wants to make self-driving cars. Ford doesn't have to hire a ton of AI experts and have them figure out through years and years of development how to make their Fords self-drive. They can just download NVIDIA's open source models, slap some cameras on their car, and they will have self-driving cars. I think every single car manufacturer will be able to just use NVIDIA's models, and I think every car manufacturer will have self-driving cars. So fundamentally, I think self-driving is actually going to be a tailwind, tailwind for Uber. So if we look at the numbers and why they're so ridiculous, We're seeing earnings growth 13%, revenue growth 11.5%. That's the forecast for the future. If we look at this, that's because earnings is expected to dip down. Once again, there were one-time tax credits. Uber was unprofitable for a long time, and they've been racking up tax credits. In 2024, they started turning a profit, and in 2025, they cashed in a lot of those tax credits. You can see revenues pretty much straight up and to the right. Free cash flow is pretty straight up and to the right. It's just the earnings a little unstable. So that's why earnings growth is only like 12 or 13%. So it was unusually high due to one-time things this year. And that's why we're gonna look at non-GAAP earnings and forward earnings and price to free cash flow instead of earnings when we get there. So past performance, you're seeing 67% earnings growth. Once again, they just upped their margins, just started turning a profit, 24%. So it's a little weirder to come up for a number here. I'll say we can go with this 13% number. If we look at the dividend, there's a 5.4% buyback. With these kind of more startup-y earlier companies, we need to compare that to the stock-based compensation. So if we look at this, stock-based compensation is 1.86 billion. So that's definitely not going to be 5%. So they are doing some pretty aggressive buybacks. My calculator will load in. So let's get this. 140.3. No, I need to do it the other way around. 1.86 divided by 140.3. So 1.3% stock-based compensation. They're buying back 5%. So they're doing a 4% buyback. So if we combine that with this 13% number, then we're at 17% growth. If we look at ownership, there is insider buying. Okay, that doesn't, I don't know if that counts. He bought 5 shares, but you can see this guy's buying $1.6 million of shares. Love insider buying. Now, if we go to the financial health, debt to equity, it's not great, but same thing as these other guys. The interest coverage ratio is negative. They're earning more in interest than they're spending, right? Uber earns more interest than it pays, so coverage of interest payments is not a concern. Their debt to equity is going, it's not amazing right now, but it's way better than it was a year ago. Anytime in the past, it's heading in the right direction, and it's still fine. They're not really paying interest. So if we look at the valuation here, let's see here. So 15 PE, we can't really use that, but 19.4 forward for a company that we've decided is growing 17%. So the forward PEG is about 1. Right? It's a little over 1. If we look EV EBITDA 20, PEG ratio 1.2. Can I get their non-GAAP PE? Uber non-GAAP PE. If we can pull this up. Non-GAAP, trailing non-GAAP PE 15, forward non-GAAP 20. So I think they're still affected by the one-time thing in the GAAP, in the non-GAAP, I mean. But still, it's a great deal if the company doesn't fall off in the future. And that's the thing. With these other ones, the future is a little more certain. With this, it's a little uncertain. It's going to be lower. It's going to earn less money next year. I think another number we would want to look at here is the price to free cash flow. Oops. What did I decide? I just pressed my mouse button. Sorry. We want to look at price free cash flow. So 9.8 billion. So we're going to do 140.3 divided by 9.8, right? Yeah, 9.8. So 14 price to free cash flow. It's a very cheap company, a fast grower. It has a bright future, in my opinion. Now, there is, once again, the possible bear case where self-driving means that Uber is no longer needed. But I think that they're diversifying. I think that there are legal issues, of course. I don't love their management, but I think that self-driving actually could be the future. I think there's a chance that more people use Uber in the future as you don't need to pay for the driver to order an Uber. No need for tipping, all of that. So I think Uber is a great buy. I think it was a great buy at $80, and I think it's an amazing buy at $60. Free cash flow, future cash flow value, it says 68% undervalued, and the analysts have it at 30% undervalued. I think there's plenty of margin of safety as with the others. So next up is Celsius Holdings, much smaller company. One you might hear a little bit about, but probably not nearly as much about. They are an energy drink company. They own Celsius, obviously. They own Alani Nu. They just purchased that. And they own Rockstar. They just purchased that. Both of those were purchased like a year and a half ago. They own like between all of their products, about 30% of the energy drink market. Celsius and Alani Nu are probably their biggest ones, and they really focus on bringing new people into the energy drink space. Celsius is like sugar-free, they kind of advertise healthy lifestyle. A lot of like people in the gym drink them, nurses drink them, a lot more like working professionals drink them. And then Alani Nu is primarily targeted at women, like college-age women, really. But they're opening up new people into the energy drink market. People who probably would got their caffeine through Starbucks before are now getting Celsius and Alani Nu. And then there's Rockstar, which they just purchased, and I think they're going to go toe-to-toe with Monster and Red Bull with Rockstar. They have a great marketing team. I've seen in my personal life, everyone's been starting to drink these recently. Everyone in their target market is drinking the drink that they're being advertised to. I've started drinking these mostly because I get offered great deals on them. But they are a fast grower. Their valuation numbers, their earnings is a little messed up right now. And I think that's the first thing we have to talk about. And then we'll compare it to Monster because that really shows how crazy cheap the valuation on Celsius is. So once again, we got to look at the growth. For me, the price and growth go hand in hand. I'm a value investor, but that's about buying growth at a reasonable price a lot of the time. So if we look at the growth here, this is not the most organic growth in the past. They just purchased these two new companies, but 36% and 42% revenue growth, right? So those are crazy numbers. If we look at the future, 26% in earnings growth, 8% revenue growth. So it's kind of hard to pick a number there. We can be conservative and call it like even 12 or 14 if we want. We can be super conservative, call it 12. Dividend, is there anything? 1% buyback yield. Once again, I expect that's probably just covering for share-based, stock-based compensation. Maybe not. Maybe not. So if we move this over here, so what was that? 30.65 divided by 6900, 0.04. So no, there's a little bit. Maybe we can bump this up to, I was saying 14. We can call it like 15 between the buyback. And once again, there's so much growth here. Now, we need to look at the past performance here of the earnings. The earnings is suppressed right now. You can see revenue's going crazy. It went up. It stalled for a bit while they were worrying about this acquisition and all the costs with that. So there were some one-time costs for the acquisition here, and now their revenue's way, way up. But let's close the revenue and look at free cash flow and earnings. So if we look here, it's actually a little bit of a mess to tell, but you can see the earnings, they're way down this year. And if we look at this, there's a large one-off loss of $421 million impacting its last 12 months. So their earnings is distorted, and that's because they just bought Rockstar and Alani Nu, and they needed to add Rockstar and Alani Nu, get them off of their old distribution networks and add them to Pepsi's distribution network. So they had contracts that were pre-existing that had not run up, and they needed to pay like severance fees, buy out the rest of the contract type thing. And then they need to pay costs to get them added into Pepsi's distribution network. All of that together was about $421 million. Now, here's the thing. Pepsi, who is invested in them, owns like 11% of the company, dozens of them, has some preferred shares, which I'll also get to in a second. They covered most of this cost. I think it was $350 or $375 million. So this cost in reality is actually like $50 to $75 million. I don't remember the number off the top of my head. But in GAAP accounting, they can't count like Pepsi's reimbursing us, like Pepsi's paying these. That's not real revenue. They didn't provide a product or service. They didn't sell anything. It's not revenue according to GAAP accounting. So they had to count the expense, but they can't account for the revenue. So because of that, their earnings looks really bad this year. And because of that, their valuation looks crazy expensive. 60 PE for an energy drink company growing 14%. Normally, I would never. But if we look at this forward PE, 17.3, well, that looks pretty good. If we look at free cash flow. Here you can see the earnings versus free cash flow is crazy. Let me pull my calculator back up. So 69,000 million divided by 292.76. Price free cash flow 23.5. If we look at Celsius's non-GAAP PE, what do we get? We get 17 to 18 and a half is their non-GAAP price to earnings ratio. So they're actually trading like 18 to 25 times multiples, which is, I think, great for a company doing somewhere between like 14 and 25% growth. Well, it's hard to tell. We could, if we use this 26% number, then that's like a peg below one, really. If we use the 14 number, then it's a peg of like 1.5, 1.6. And then there's also the preferred shares, which is a thing. So Pepsi has 11% of the company, but they got that through like convertible preferred shares that also pay them a dividend. And that dividend is like 33% of the company's earnings. So with 11% ownership, Pepsi's getting like 30% of their earnings. There is other risk. Costco just introduced an energy drink, but I think that all that risk is more than compensated in this very, very good price. You're getting that 18 non-GAAP PE. You're getting 17 forward PE, 16 forward PE. The price to sales is 2. And I want to do a side-by-side comparison to Monster. So if we look at the valuation here of Monster, you can see Monster, I think, is overvalued. I don't know if I showed this at the beginning. Let me go overview. So we're getting, that's just some random dude. Wait, how do we get future cash flow for Celsius? 69.9% undervalued. It thinks it should be $90 a share according to cash flow. Consensus target says that it should be $56 a share, that it's 52% undervalued. So we're talking about 60 to 50% undervalued on this stock. And I like the company. I actually like the company. I think they do a great job marketing. So anyway, back to looking at them side by side with Red Bull. So 70% undervalued versus 11% overvalued, right? The PE does not look great for Celsius. Of course, 45 versus 60, but if we go forward, it's 40 versus 17. If we look at price to sales, it's 2 versus 10. If we look at price to book, it's 5 versus 10. If we look at these EV EBITDA, 13 versus 31. EV revenue, 3 to 10. PEG ratio, 2.3. And once again, that's really like 1.5, 1.2, something like that. Maybe even 1 versus 4.5. If we look at the price to free cash flow, I think we already did the math for Celsius, right? It's about 25. If we look at it for Monster, it is 991 divided by 2.05. It's 44 price to free cash flow. Now, Monster has what percent of Monster energy drink market share? They have 37 to 39% of market share, right? Celsius Holdings energy drink market share, 20%. So Monster has 80% more market share than them, and it's trading at over 10 times the market cap. Compared to Celsius, Celsius is a $6 billion market cap. Monster is a $91 billion market cap because they have 80% more market share. So comparatively, also, I think that it really highlights how massive of a discount Celsius is. I'm buying more Celsius. I think that it's a great product, great company, and a great discount right now. And I think a lot of it is due to people not fully understanding those accounting oddities, making the PE look abnormally high. So now on to the final stock. And that's going to be probably the most obscure one of the day. That's New Holdings. This is a Cayman Island company. They are on a Fintech app in mostly Brazil, but also Colombia, Mexico. They're expanding into the U.S. They're trying to get their bank. They did get a banking charter in the U.S. They're going to expand here. Their thesis being if they can get 1% of the market share in the U.S., and there are a lot of unbanked people who speak Portuguese and Spanish in the U.S., if they can even get 1% of the U.S. market share, it would like double their earnings. So If we look at this, and my main thesis here is that it's very similar to SoFi, except it appears to be a better company with some more risks, but it grows faster and has a lower cost to acquire customers than SoFi, and it's trading at like half the valuation of SoFi. So anyone who likes SoFi, I look at SoFi and SoFi looks too expensive, but I look at New and it looks like a better company with more risk, and you get twice as much company for your dollar. So if we look at the consensus target, 21% undervalued. If we look at cash flow, which isn't great for banks, really, 13.6% undervalued. Let's just go look at SoFi. If we look at cash flow on SoFi, 18.5% overvalued, right? If we look at consensus target, they say 21% undervalued, according to the analysts. So let's go back. Okay, so I think I'm actually going to want to side-by-side these here just to show off my point. So let me go look. We're going to look at future growth projections. So on the left, we have Nubank, and it's once again, they are very similar companies. I have read the 20F for Nubank, and I have read the 10K for SoFi. They are basically identical business models. It's banking, but asset-light banking. They don't need branches. They don't need to hire tellers, all that. They can expand over the whole country at once. They don't need to slowly expand by building new branches and buying new machines and putting ATMs and all this stuff. They just need people to download their app. They have a very low cost to acquire customers. Both of their price to book, which is normally how you would value a bank, is pretty cooked. Both of them have crazy price to books, but it's much less of an issue, and I think it is okay to value them on earnings growth and revenue growth. Anyway, so earnings growth, 20 to 25%. So the earnings is predicted to grow a little faster for SoFi. The revenue for SoFi is predicted to grow much, much faster, 43% versus 17%. If we look at past growth here, we get 67% earnings growth for 61%. If we look at revenue growth, we have 30% for SoFi. We have 43% for Nubank. So all of these except the future forecasted earnings growth is better for Nubank, and they both of them beat pretty consistently. So who knows? But I think both are good. If we look at another one that's important for banking is return on equity, return on assets. So let's go take a look at those two. Very important in banking. So return on equity for SoFi, 5%. Return on equity for Nubank, 25%. If we look at return on assets, 4% versus 1%. So in banking terms, that would mean that this is like a 4 times higher quality bank. Now, it is riskier. They are giving credit to people in Brazil and Mexico and Colombia who have never had credit before. They have massive write-offs. When I looked at the thing, when they hand out credit, they expect massive losses, massive amounts that not to be paid back, but they do account for that in advance. If there's a credit cycle, it'll probably be worse down there. Inflation is worse down there, but the numbers do kind of speak for themselves. But we look here at the okay, so free cash flow you really don't want to look at for banks. Just straight up free cash flow is a nonsense number for banks. When money comes in, that's a liability, but that's cash flow in. When they give out a loan, that's cash flow out, but that's them gaining an asset. So you just never want to look at it. And if we look at it, pretty up and to the right on revenue, pretty up and to the right on earnings, SoFi has been a little more unstable. If you look at dividend, there really should be nothing here. Yeah, neither of these should be paying a dividend. It looks like SoFi is actually diluting shares. There's massive insider buying on SoFi, no insider buying on Nubank. One thing with Nubank, it's Cayman Island holding company, so you have less shareholder rights, and the owner has like all of the voting power. He has a different class of shares. He has all of the voting power. So shareholders have been diluted in SoFi by 16%. I don't like shareholder dilution. Personally, I really don't touch it. They're fundraising off of me. I don't like it. There are times where it's a good capital allocation decision, but that would be when the shares are overvalued. But they're apparently undervalued because the CEO is buying shares left and right and saying they're so cheap. So why are they diluting? Doesn't make sense. So anyway, after looking at all of that, let's look at the valuation for these two companies side by side. So if we look here, 21 price to earnings ratio versus 36. If we look forward, 16 versus 25. If we look at the price to book, I think this might be, yeah. So SoFi has them beat on price to book, but the return on equity is 4 times higher for, or 5 times higher for Nubank. Their return on assets is 4 times higher. So they are getting more work out of their book than SoFi is. Price to sales, 9 to 5 times. 9 versus 5.4. I don't know if EV, but any of these matter. But PEG ratio of 1.1 versus PEG ratio of 1.5. So I think side by side, to me, this looks like a much better buy, and you get it by looking overseas. I think there's this Hail Mary play they're throwing out of going to set up in the US. And once again, their argument is if we can get 1% of the market share in the US, that will double our earnings versus getting a whole new country and taking over the whole country. It looks like there's still a lot of room for them to grow in Brazil and a ton of room for them to grow in Mexico and Colombia. It remains to be seen how creditworthy these places are, but I'm willing to invest in these countries and bet on their future. I do think that Mexico, Colombia, and Brazil actually have a pretty bright future. And when you are buying banks, you are betting on the future of their customers, right? If their customers have healthy financial futures, they will pay back their loans. They'll take out more loans. They'll use those to buy good things. So when you buy a bank in India, you're betting on the whole Indian economy. When you buy one in Canada, you're betting on the Canadian economy. And here you are betting on the future of Latin America's economy. I think them getting into the U.S. fixes some of that, but still their clientele are going to be people who probably don't speak English as a first language and probably aren't as wealthy as the average American. But I still think that there's a ton of upside here. I think compared to SoFi, and SoFi's like a cult. I hear everyone saying SoFi. Every time I look at the numbers on SoFi, it doesn't really make sense. I have the CEO of SoFi saying that they're going to be like a $1 trillion company soon or something. And it's like, that would make you the biggest bank on earth. So you get a lot more company for your dollar, even though new is more expensive. The other thing is they are competing with Mercado Pago, but SoFi is competing with a ton of banks in the fintech apps in the US too. New is really only competing with one, which is Mercado Pago, and maybe they use their like Amazon level monopoly powers to push new out and take over. But new one, it seems to have great word of mouth. They don't even need to advertise. They just give their clients such a good experience that they spread through word of mouth, it seems. I think between the two, I think new looks like the obvious buy to me. And I'm very bullish on this. I think that there's going to be a lot of upside in the future. This is like Celsius. This and Celsius, they're smaller positions. And I think both of them have the opportunity to even 10x in like the next 10 years. So this is one I'm just going to hold and see what happens. I think that there's a lot of upside and I'm getting a lot of company for my dollar. So that's all. So thank you guys for watching. Like, subscribe, comment, tell me what you think about these. Tell me if there's any companies you think I should look at. I think I might do some soon on companies I might be adding to my portfolio. I'm always researching companies, and there's some I might be adding to my portfolio. And soon there's at least one that I'm looking for an opportunity to sell my gains and put it into something else. But these are the 5 that I'm going to be buying more of this month, basically. All of these are below my current cost basis. I think these are all at a great price, and I think that they're all pretty good companies. So thank you for watching and have a great day.